So this week we've been talking about different types of accounting information systems and then some different journals that you can use that help to make your task of recording transactions a little bit easier. This chapter, I do know that there is a little bit less work involved this week on Connect, so that is a good thing. And you should all do pretty well, hopefully, with this. So let's look at exercise 7.1, which is dealing with how to use the sales journal. So we see here that the Finer Company uses a sales journal, a purchases journal, a cash receipts journal, and a cash payments journal and a general journal. And so first of all, we're going to journalize the following transactions that we would record in a sales journal. Okay, so the sales journal is used when we sell merchandise on account. And so we debit to accounts receivable, and then the credit would be to sales. Okay, so let me just say that again before we move on. So we use the sales journal to record those transactions where we have a sale of merchandise on account, meaning that we've not collected the cash yet, but we expect to. So we would have a debit to accounts receivable and then a credit to sales. Then we use the purchases journal when we purchase on account, including merchandise. So we make any kind of purchase on account, we would use the purchases journal. So you would credit accounts payable, debit whatever it was that you received. So if you received supplies or you received merchandise inventory, etc., you would debit that because that's an asset, and then you would credit the accounts payable because, again, purchases on account. Now, the cash receipts journal then is used for any transactions that would have a debit to cash, meaning that you're receiving cash. So it could be cash receipts from your accounts receivable. It could be cash from any kind of interest income, anything like that would be recorded in the cash receipts journal. The cash payments journal is used for any transactions where you're actually paying out cash. So that would be when you credit cash, okay? So you debit whatever, so like debit accounts payable, and then credit cash, for example, okay? And then you would use the general journal then for anything else that does not fit in any of these categories. And so the general journal is used for your adjusting entries, your closing entries, anything else that doesn't fit in these other categories. So again, looking at this, we're going to have to categorize then what journal we would use. So the first transaction we see happened on May the 12th, and let me change my pointer here. Okay, so on May the 12th, we sold merchandise that cost $300 to Beef Facer for $450 in cash, invoice number 5703. That would be cash receipts because we gave them the merchandise, they gave us the cash right then that same day. So that would go down here in the cash receipts journal. Okay, so right now we're not concerned about it. We'll be concerned about it later. Then on May the 5th, we purchased $2,400 of merchandise on credit from Marchant Corp. Well, it says we purchased merchandise, so debit merchandise inventory, credit accounts payable, because we've not paid it yet, and that would be used in the purchases journal. Bingo. This will be our first one that we'll journalize here in a minute. Is on May the 7th, sold merchandise costing $800 to J Dryer for $1,250 terms, which is $310 net 30. So that is a sales journal. And so the reason is that we've sold merchandise, but we've not received a cash payment yet. So they're getting a 3% discount if it's paid within 10 days. Otherwise, they have 30 days to pay. So we record that in our sales journal. So now that we've come to that, we'll go ahead and journalize that. So you have a sales journal. It has the following columns. You record the date, the amount that would be debited, the invoice, and then accounts receivable credit, and then cost of goods sold debit and inventory credit. Okay, and that's what you would then record then to your ledger when you go to do that. And I tell you here how to do that. So we would put the date, which is May the 7th, to J. Dryer, invoice 5704. And then the sales accounts receivable debit, sales credit of $12.50. So the reason for that is because our accounts receivable will debit that because that's an asset that's going to increase because we expect that we will be paid that. And then we're going to credit sales because sales then is on the other side of the equation for the income statement. And then our cost of goods sold debit, inventory credit, 800. And that is because that is the cost of the merchandise, our cost. So we will debit the cost of goods sold because that then is used for the income statement as an expense. And then because we've credited sales, which would be the income for the income statement. So then that debit because that's the expense. And then we will credit the inventory because now we need to decrease the amount of inventory that we have by what it cost us. Okay, let's look at another one. May the 8th, borrowed $900 cash by signing a note payable to the bank. So that's a cash receipts journal because we've received cash. And in this case, we received a bank loan from the bank. So we owe the bank money, we received cash. But in that case, we would use the cash payments journal to record that. And in May the 12th, we have another sale. We sold merchandise costing $200 to R. Lamb for $340 again, in just terms of net 30. So they have 30 days to pay, invoice 5705. So if we were to record that in our sales journal, May 12th, R. Lamb, the invoice number 5705. Again, accounts receivable debit, sales credit of $340 because that's what we received from, or what R. Lamb owes us, I should say. And then the inventory, the merchandise that we sold R. Lamb, it actually cost us $200. So we would record that. Let's look at another one. Received $12.25 cash from J. Dryer in order to pay for the purchase on May the 7th. Well, that would not affect our sales journal because we're receiving cash from J. Dryer, but what that would affect is our cash receipts journal. And then on May the 19th, we sold used store equipment, which would be non-inventory. It's store equipment. So it's not something that, it's not our primary business. Our primary business isn't selling store equipment. It's selling whatever we're selling, okay? So it's not inventory for $900 to Golf Inc. So that is a cash receipts journal entry. Whoops. And then May the 25th, we sold merchandise that cost $500 to Trailer for $750. Again, they had 30 days to pay, invoice number 5706. So you have May the 25th, T. Taylor, 5706. So then again, we are going to collect from T. Trailer $750, but it cost us, the merchandise that we gave them cost us $500. So let's look now at the cash receipts journal and how we would do that. But I'll still, this is actually a different scenario, but I'm still going to go ahead and go through this with you. So we kind of figure out then kind of where things go. So Alley Company uses a sales journal, a purchase journal, cash receipts journal, cash payments journal, and a general journal. The following transactions occur in the month of November. So on November the 3rd, they purchased $3,200 of merchandise on credit from Hart Company, and they had 20 days to pay. So that would be the purchases journal. And then because we purchased merchandise on credit. Now, on November the 7th, the company sold merchandise costing $840 to J. Than for $1,000 on credit, subject to a $20 sales discount if it was paid at the end of the month. Okay, so that is a sales journal. And in November the 9th, the company borrowed $37.50 cash by signing a note payable to the bank. So they received a bank loan. So that's a cash receipts journal. So we'll take a look at how we record that. So again, cash receipts journal, you record the date, the amount that's credited, the amount of cash that's received, or excuse me, the account that would get credited, the cash that gets debited, the amount, the sales discount debit if you have that, the accounts receivable credit if you have that, sales credit if you have that, any other account, and then the cost of goods sold debit and the inventory credit. You would record that here. So again, depending upon what scenario is happening. In this case, we're receiving cash as a result of a bank loan. So we receive cash in the amount of $37.50, and then we have to credit notes payable for that amount also. So you debit cash in the amount of $37.50, you'll credit the accounts, the notes payable for that amount. Let's look at the next one. On November 13th, Jay Ollie, the owner, contributed $5,000 cash to the company. So in this case, we would record it as, again, the date, the cash amount that we received, which is $5,000, and then we would go ahead then and credit J. Ollie capital. So you debit cash, credit capital. And then again, it would be you would credit the other account for that amount. So now the next thing then is November the 18th, the company sold merchandise that cost $250 to B. Cox for $3,300 cash. Well, that's a cash receipt. So we record the sale November the 18th, cash debit of $330, and then we would go ahead and credit sales. So we debit cash the amount of $330, we credit sales in the amount of $330, and then the cost of goods sold then is, in the inventory, is $250. Then on November the 22nd, the company paid Hart Company $3,200 for the merchandise it was purchased on November the 3rd. That's a cash payment, so we record that in a cash payments journal. So we're not concerned with that right now. November the 27th is the company received $980 from J. Than in payment of the November the 7th purchase. Well, that's a cash receipts journal. So we have November the 30th. Again, we received cash, the amount of $980. And then he did, because he paid it by the end of the month, he qualifies for his $20 sales discount. So J. Than, his accounts receivable is $1,000 credit, because we're going to then go ahead and he owed us $1,000. He's now satisfied that, so we're going to credit accounts receivable $1,000. So then this one then is how to use the purchases journal. The following information from Jesper Company for its first month in business. So they had credit purchases and then the cash that was paid for those purchases. So we'll journalize the above transactions in the accounts payable subsidiary ledger. So again, each company then is going to have an account in there. So Bailey Company, Johnson Brothers, and Preston, they're each going to have an account within the accounts payable subsidiary ledger because we owe them. So then we just record January the 9th, credit of $14,000. So they have a balance of $14,000 owing that we owe them. Johnson Brothers, we purchased from them on the 18th. So credit of $6,600, and then we still owe them that amount. And then on January the 22nd, from Preston, we had a purchase from them of $6,200, so we owe them $6,200. So then what we'll do then is we have to record the amount that was paid to them. So Bailey Company, on the 19th, we paid them $10,100, so that would be a debit to their account. And then now they have a balance owing of $3,900 that we owe them. And then Johnson Brothers, you have their payment of $6,600 debit, and that clears the balance there. And then Preston Company on January the 31st, $5,400, that leaves a balance of $800. And then it says journalize the accounts payable balance in the general journal at the end of the month. So then what you would do then is on January the 31st, you would record the amount of purchases that were made in accounts payable of $26,800. So that would be a balance of $26,800. And then also you would then go ahead and record the payments that were made, which was $22,100. And so that leaves the balance of accounts payable that you still owe of $4,700. Okay, Gomez Company uses a sales journal, purchases journal, cash receipts journal, cash payments journal, and the general journal. Journalize the following transactions that should be recorded in the purchases journal. So again, we see the different ones, and then we'll see then how we'll do this. So on July the 1st, we purchased $1,500 of merchandise on credit from Hector. So that would be something that we have to record in the purchases journal. So July the 1st, and the account is the Hector Company because that's who we owe. Invoice date was 7/1. Terms was net 15. We have 15 days to pay. And so you have inventory debit of $14,500 because we received inventory in that amount. And then we have an accounts payable credit of $14,500 because we still owe that. And then the next one then is July the 4th is sales merchandise costing $320 to C. Paul for $430 in cash. So that one, it's cash receipts because it was a sale that was made on cash. So we won't record that right at this moment. Now on July the 8th, we purchased $420 of office supplies from Zhang Company on credit, and we have 30 days to pay. So that is a purchase. We purchased office supplies. And so again, July the 8th, Zhang Company, so July 8th, and then on terms of net 30, this time we would debit office supplies, $420, and then we would go ahead and credit the accounts payable for that. And then on the 15th, we paid Hector $14,500 cash for the merchandise that was purchased on July the 1st. Well, that would go in the cash payments journal. So we'll look at that a little bit later. Now, on July the 21st, we purchased $885 of store supplies on account from Staples, terms of net 30. So again, we did it on account from them on credit. So it would be part of the purchase journal. So July the 21st, store supplies Staples. Are the accounts involved? Because we're increasing on our store supplies, and then we're crediting our accounts payable at Staples. So we have net 30 to pay. So other accounts debit would be $885. And then accounts payable, which would be the accounts payable for Staples, would be $885. And then on the 22nd, we sold merchandise costing $2,000 to Microtran for $2,500 on credit terms of net 30. Well, that is a sales transaction, so that would be in our sales journal. And then on the 23rd, we purchased office supplies from Depot for $305 in cash. So that's a cash payments journal because we're paying them cash right then and there. Okay. And then on the 25th, we purchased $3,000 of merchandise on credit from Alfredo Company, net 30. Well, then here we are back again at our purchases journal. So on the 25th, Alfredo Company. So again, inventory, because that's merchandise for resale of $3,000, and then accounts payable of $3,000. And then finally on the 27th, we paid employee salaries of $1,650 in cash. Now, again, this could have been by check or direct deposit, but still, it'd be cash, like we say. So that goes in our cash payments journal, which is identifying the journal for entry. So we're going to look at these, and then we're going to figure out what journal we would enter these transactions into. So Mark's Supply uses a sales journal, purchases journal, cash receipts journal, cash payments journal, and a general journal. Identify the special journal in which each of the following transactions should be recorded. So we see here that on April the 3rd, we purchased merchandise for $2,950 on credit from Seth Inc. Terms 2/10 net 30. So again, 2% discount if paid within 10, but it's due in 30 days. And again, we have our different journals. So that would be a purchases journal because we are purchasing merchandise from then. So we would debit the merchandise inventory and we would credit accounts payable. Seth. Now on April the 9th, we issued check number 210 to Kit Company in order to purchase, buy some store supplies in the amount of $650. Well, this would be a cash payments journal because we're writing a check ourselves in order to do that. So we would debit the store supplies and then we would credit cash. Now on April the 12th, we sold merchandise costing $500 on credit to C. Mayors for $770, and again we have terms of net 30. So we sold merchandise on credit, so that would be the sales journal because we haven't received payment for it yet. And on April the 7th, we issued a check for $211 to pay $1,400 to pay off a note that we had payable to Citibank. Well, that would be a cash payment journal. Okay. And on April the 30th, we purchased merchandise for $4,500 on credit from Light, terms of 2/10 net 30. So again, purchases, that would be the purchases journal. Okay. We purchased merchandise. So again, debit merchandise, credit, accounts payable, Light. And then on April the 28th, we issued a check number 212 to Light in order to pay for the amount that was due on a purchase less the discount. So that would be a cash payments journal. And then on April the 29th, we paid salary of $1,800 to B-Doc by issuing a check number 213. So that would be a cash payments journal because we're issuing a cash payment. And then on April the 30th, we issued a check number 214 to Seth Inc. in order to pay the amount that it was due for the third purchase. That would also be a cash payments journal. Posting the subsidiary journal and how to prepare the statement for our accounts payable. At the end of May, the sales journal for Mountain View appears as follows. So we see here, these were all the sales that they made. And so we would go ahead, when we go to journalize this, we would debit the accounts receivable for this amount. We would credit sales for this amount, and then we would go ahead and debit the cost of goods sold for this amount and credit our inventory, because this is what our cost is. This is what we actually are expecting that will be paid. Now, Mountain View also recorded an allowance, which would be a price reduction that was given to Anna Page for the with the following entry. So on May the 20th, they had a sales return of allowances of $350, and then that reduces the accounts receivable by $350. So first of all, what we'll do is we'll go ahead and post the customer accounts to the customer accounts, the entries in the sales journal and any portion of the general journal entry that affects the customer's account. And then we'll go ahead and post the sales journal amounts first, and then any portion of the general journal entry, that affects those accounts. And then we'll go ahead and prepare the schedule of accounts receivable, and we'll prove that its total equals the balance in the accounts receivable controlling account. So first of all, we'll go ahead and record the sales. So we have our accounts receivable subsidiary journal. So again, each of our customers has an account in there. So the first one is Aaron. So Aaron Reckers. So on May the 6th, debit in the amount of 3,880. And so that's the balance. And so the debit, because remember that accounts receivable is an asset and we're increasing an asset. So we'll debit that. And then the next one is Sarah Reed. And then we'll go ahead and put a check here that we've posted it, which that verifies that we've posted the first section here of this into the accounts receivable. And then on May the 10th for Sarah Reed, we'll go ahead and debit 2,940. So then that leaves that, and then we'll go up here, we'll place a check. And then on May the 17th, we will post a debit in the amount of $1,850 to Anna Page. And then on May the 25th, we'll go ahead and put down here the sale that we made to Sarah Reed. So May 25th, $1,340, and we'll just add $1,340 to the balance that she had. So Sarah Reed now owes us a total of $4,280. So now the next thing we have to do is we have to go ahead and update Anna Page's account to reflect the discount that we gave her. So on May the 20th, we would credit $350 because we're now reducing the amount that she owed. So we would subtract $350 from $1,850. So now she owes us $1,500. And then what we'll do then is in the general ledger, on May the 31st, we would have a debit in the amount of $10,010 because that's the amount that we're owed. And then we would record sales credit in the amount of $10,010 because that's the amount of sales that we had during the month of May. And then we would go ahead then and record the cost of goods sold. So we would debit cost of goods sold for $8,000 because that's the total cost of what the merchandise that we sold cost us. And then we'll reduce the inventory by crediting it. And then we're assuming that there was a $20,000 balance of inventory that we had available previously. So then by selling $8,000 of it, it leaves $12,000 in inventory that we have currently. And then our sales, returns, and allowances. On May the 20th, we have a debit of $350 because we've given that. Basically, this would be like an expense or a contra to the sales because we've given out that discount. So now what we'll do is we'll go ahead and create the Mountain View schedule of accounts receivable. So we'll go ahead and list out each of our customers and the amount that they owe us. And then we add them up. Comes out to $9,660, and we see that that matched what was there previous.